Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. 15 Minutes of Finance is back. We've had a big week. We have a bigger month coming up and then a bigger fourth quarter. We got a lot of stuff going on. Nvidia gave its earnings. Everybody was shook by that. Other chip makers are dropping 30%. Intel went wild. A staple in the technology world just dropped 33%. Wild week we've had. Let's just jump right into the news here, guys. Let's look at this. So U.S. stocks wrapped up a volatile month on a high note Friday as major indexes surged in late trading to close near session highs. The Dow Jones Industrial Average gained 0.6 to close as record high for the fourth time this week, while the S&P 500 and NASDAQ Composite gained 1% and 1.1 respectively. After sharp declines earlier in the month amid mounting concerns about a possible recession, which we've been hearing about that constantly, all three major indices managed to finish August with monthly gains as investors' economic fears have subsided and expectations have increased that the Federal Reserve will cut interest rates soon. The early Friday release of the Fed's preferred measure of inflation showed that price pressures continue to ease in July, reinforcing the notion that the central bank will be in a position to cut its benchmark lending rate. Jerome Powell, the Fed chairhead, has signaled that rate cuts are coming, possibly as soon as the September meeting of the central bank's policy committee, but has said that incoming data will drive the decision on the pace and depth of the easing. The yield on 10-year treasuries, which is sensitive to expectations around interest rates, rose to 3.91%, near its highest level in 2 weeks. Among stocks that moved on Friday, Dell Technologies gained 4.3% after reporting better than expected quarterly results on the strength of the AI-related sales. Shares in MongoDB, ticker MDB, soared 18% after the company reported strong earnings and boosted its full-year guidance amid robust AI demand. Never heard of MongoDB, but I like that name. Totally irrelevant name. For some reason, I love companies that their name has nothing to do with what they're trying to do. MongoDB, I'm going to have to look into that. So speaking of AI, chip makers, which have been among the more volatile stocks in recent weeks, more like recent years, posted solid gains Friday when the iShares Semiconductor ETF SOXX was up 2.6%. Marvell Technology, ticker MRVL, rose 9.2% after a positive earnings report, while Intel, INTC, gained 9.5% following reports that the chip maker is considering the spin-off of sale of its foundry business. Mega cap tech stocks were mostly higher, led by 1.5% gain for AI investor favorite Nvidia, which recovered from a sharp decline yesterday after its highly anticipated earnings report fell short of the most optimistic expectations on Wall Street. Microsoft, Meta, Amazon, Google, and Apple all fell slightly. And gold futures were down about 1% to around $25.30. That's $2,530 per ounce, while Bitcoin was down slightly to just below 59,000. Okay, guys, let's cover some of this stuff here. So first and foremost, let's just talk about Nvidia and get it out of the way. Okay, Nvidia did good. They had a great quarter. Okay, people still wanted better. Right? You're never probably going to do enough with Nvidia, but what that does for me is that means that next quarter probably they'll lessen expectations, and then Nvidia will still do well. Ideally, they'll exceed that expectation, and we'll see a big bump in the trading around the earnings report of Q4. However, this is really why the stock dropped. So there's something called shorting, which a lot of you probably know what that is. But for those of you who don't, it's just betting against the stock. So you're basically saying, I'm going to bet $10 that the stock goes down, right? And so you buy a right to the stock at a current price, right? And if it goes below that, you execute it. Okay, so now you can sell that stock at the higher price, even though the stock is. So for example, you pay $10, Nvidia's at 120. Okay, and you think it's going to go to 100. Well, you pay $10, and if the stock goes up, you lose $10. But if the stock does go down from 120 to 100, you can sell it at 120. Okay, and so you can make that 20% difference roughly when you bet against it. And so there was a lot of options betting against Nvidia, and I think it was something like 73% of the options were saying that Nvidia was going to go down. So there was a lot of people betting against it, and that, of course, is going to drag the market price down. So I'm still extremely optimistic about it. I don't think it's anything to be concerned. I still think it's a buy right now. I think it's around 118. Let me look at where it is right now. Nvidia. Yeah, 119.37, and yeah, 119.37. So still, I would say a good share price to buy it at, and we're optimistic over at our firm. And if you don't own it or you haven't been participating, you can just get the overall AI chip maker ETFs that we mentioned. SOXX, I think, is one of them. You don't have to be individually invested into one company, right? You don't have to take that risk. It's just that Nvidia is sort of the trailblazer. They're the Patriots of it's football season, so they're the Patriots with Tom Brady of these chip makers. Let's look at a couple other things. I did want to talk about Intel. I own Intel, okay, for a few clients, and I owned Intel when it was at $30. Okay, that's pretty brutal because it dropped 33%. Now, it's not very much. I would say maybe there's $30,000 worth of it in people's portfolios, but that's tens of millions of dollars. So in the grand scheme of things, it's not that much, but it's a little just disheartening because it did drop 20%. So now it's like, okay, what do I do? Do I cut our losses? Do I still think it's a buy or a hold? Is it a buy now? Those are the thought processes we have to go through. And yeah, I mean, look at this. Intel went up 10% this week. Okay, that to me is like, all right, it's a good hold. They're trying to make changes. Intel is archaic. So I have a friend who's dating somebody who makes, she works in the Intel chip making, like on the floor. Like she's at like factory production. I think her schedule's like 3 days of work, 4 days off, or something crazy like that. And she's on the floor. Okay. And if the SEC is listening to this, I did not sell, even though I did have, technically, I had some good insider information here. She told us, she's like, hey, by the way, like they're going to be cutting off 20% of the workforce and getting rid of departments, et cetera, et cetera. And in my head, I'm like, oh, I could sell, and then I could get back in at that price. But I don't think that's the moral right thing to do. And in the grand scheme of things, it's such a small amount of money that it's actually worth just holding, just seeing what happens. So yeah, there's Intel. I think they probably will sell some of their business, and they'll focus on more of the growth-oriented side of the chip making, right? Intel's been around. I mean, how long has Intel been around? I bet 80s, probably. So, we're talking about a 40, 50-year company. All right, another good one that I want to talk about is Western Digital. So WDC. Let me read this just summary real quick. WDC shares were up 4.1% on the day. Earlier this week, analysts at Citi boosted their sales estimates for solid-state drives, predicting favorable supply and demand dynamics. Western Digital also received approval this week for a project to expand hard disk production in Thailand. Okay, so here's the big thing with WDC. It's one of the very few AI chip making companies that are American based. Okay. And there are actually tons of them, but this is one of the more successful ones. I think they've got like 51,000 employees, something crazy like that. They're headquartered out of San Jose, and I think I started tracking them. I definitely put a bunch of client money into this position. Let me just pull up so I can see what it cost back in February. So it's $65 right now. And we got in, or no, it was January. Sorry. We got in around, is it even sooner than that? Yeah, my bad. I got in around December, around $43. So November, $47. I'm so sorry, guys. But it went all the way up to 81. Okay. And so that's what you're going to expect with these chip making companies. And I'm a big believer in geographical diversification. So you can have Nvidia, you can have WDC, then you can also have, what's another one? Holy cow, I'm skimping on all my AI stocks right now. Qualcomm. Okay, you can have all these companies that are big in the chip space, but I like it geographically separated, mainly because, even the Taiwan semiconductor companies, everybody does things differently, okay? And every state, every country has different regulations. WDC is going to be able to interact with the market changes and with the AI chip space differently than Nvidia is. Okay, another good one is Palantir. They just interact differently geographically. Okay, you would think, oh, they make chips, they both interact the same way, but that's not true. I mean, a good example would be like football and oh my gosh, it's the New Zealand sport, rugby. Goodness gracious, my head is gone already. It's not even the end of the day and my head is gone. They're technically very, very similar, but they're totally two completely different sports. And that's what's really cool about this space is like WDC is more of storage. So they're not trailblazing like Nvidia or Palantir would be, or SOUN, SoundHound. They're more trying to get the storage space, right? So our phones that go from 120 to 260 gigabyte storage, that's kind of the WDC space. And I like them. I'm a big fan of them. I just think that they, that fluctuation in their stock price is just going to be like, that's the name of the game. Okay. I got 4 minutes left here, and I do want to talk about a couple of things, not necessarily politically, but the taxation of what either one of our presidents might do here. So we got Trump and we got Kamala, and in both scenarios, there's potential for success and there's potential for failure. Okay. So I just want to be very upfront about that. Trump's big tax situation is he's not going to tax tips. Well, he said that, and then Kamala said she's going to do the same thing. So either way, that's the big benefit to people taxation-wise, and then the big punishment is going to be the unrealized taxation of assets, okay, unrealized gains. So what's really important to keep track of here, that is extremely immoral. It doesn't matter if it's on people who only have $100 million, which is, what the buzz is. It'll only happen on people who have over $100 million net worth. So don't worry if you only make 40 grand and you're the average person. What does that matter to you? I think that's totally the wrong way of thinking about it. And second off, this is the other big thing. The goal should be to be, especially if you're an entrepreneur or if you're in these very successful industries, right? So you're making $250,000, $500,000, or if you're saving, right? So if you're a teacher and you're saving 30% of your salary, these things are important for you, okay? So what'll end up happening is eventually it'll go to the 401ks, because 401ks is where a lot of people's net worth is. It's either their house or their 401ks. Okay, well, with both of those, okay, there's a lot of taxation to be considered. You can't take money out of your 401k till you're retired or 59 and a half or whatever all the speculations are. And with your house, it has to be your primary house. If you sell it, there's going to be cap gains on it. But if you also have another house, or an investment property, there's all these different things. But most people's wealth are tied up in both of those. So now, $100 million. Do you know how many 100 millionaires there are? Okay, this is funny. I only know the answer to this because me and Brandon, the CFO at our firm and the head of our tax department, we had a client or a referral for a gentleman who inherited $150 million. Okay, that situation is bonkers. That whole, what a wild lucky kid, right? But how many 100 millionaires do you think there are in the world? Okay, there's something like 27,000 of them. It's not that many. It's not that many people. So what will end up happening with this taxation is it'll start there and then it'll trickle down. It always trickles down. It never stays where it's at. So that's the first thing to consider. So if they come after the 401ks, let's just use an example. Let's say you have $10 million in your 401k. Not unreasonable for someone to have that. It is pretty high, but not unreasonable. Well, if you own Apple or you own, what would be a good stock? Uber, right? Uber came out 4 or 5 years ago, 6 years ago. So you've owned Uber since the IPO. Well, now under that unrealized tax law, if you have $100,000 worth of Uber, you bought it, and then it goes to $200,000. Now you have to pay taxes on that $100,000 difference from your own money. Okay, because you can't sell and create a taxable event within the 401k because you can't take money out yet. Okay, so now you have to find 25% of that $100,000 just somewhere else. right? And then nothing happens. And then what if, so you've paid your tax now, right? So you paid it. And now what happens if Uber crashes, right? And Uber goes down to, your position goes down to $50,000. Okay, you've already paid $25,000 on that. So now not only have you lost that $50,000 or the $50,000 between when you bought it and where it's at now, $100,000 minus $50,000, but now you've have to add that $25,000 that you paid on taxes. So now you're out $75,000. Okay, that is a horrible, horrible plan. I hope that made sense for you, made sense to you guys, because that's the way it's going to go. So every year, if you have a really, really good year, you have to pay taxes. But if it goes down, you know, and you're freaking out, like an 08 happens, and you sell everything, right now you didn't just lose your account value, you also lost whatever you paid taxes in. So I'm not telling you who to vote for, not at all. Okay, you vote for wherever you feel morally you align with. But I am telling you that if you like investing and you like saving money, any sort of unrealized cap gains is extremely immoral, and it will destroy incentives for people to invest. Absolutely destroy incentives. I don't think it's possible. I think there's just too many people who enjoy investing that are, you know, funding these politicians that it just would probably never happen. One thing that should happen, and this is where I would solve some of these problems, if you voted me in for president, by the way. I'm putting my name in the next ticket here in 2028. I'm going to be putting my name in. Kidding. But if we honestly just said, hey, look, we understand people smoke marijuana, and it is what it is, and you taxed it like you tax cigarettes, that would take care of an immense amount of the issues. And if we could just do it right, okay, just try to do it right. We have alcohol after prohibition. We have tobacco after the big pharma stuff in the early, was it 50s or 60s? I can't remember, whenever the taxation really hit the wall or hit the ceiling. But if we went about it that way, we could fix a whole bunch of taxation issues that we're facing. So, guys, that is it for today. Okay, it was a lot. We went over a lot of things. Really quickly, we are doing a total rebrand online. Okay, we are changing up everything. We now have not just this podcast. We have another segment called Two Gents, 2 Cents. We have a newsletter called The Trading Desk with stocks to watch, markets insights. You guys can get a grasp of what it is that I'm thinking about, what it is Brandon's thinking about when we make these investment choices for our clients. It's really worth the time and the read. It's only $10 a month or $100 a year. Okay, so you pretty much save 20% by just paying for an annual subscription. Every month you'll get this newsletter. There's always stocks, always, and we invest in a lot of them. Okay, so the stocks that we've picked in this newsletter so far, not that this is tailored advice, but we've done about 60% year to date. Okay, that's very, very good. Again, there's a lot of fluctuation. We have a lot of chip stocks in there. But year to date, we're right about 60. S&P's right about 20. So do with that what you will. If you like doing your own investments, that's for you. That's why we made this, to be a resource and an asset to you. And yeah, guys, give the podcast a share and a follow. And then if you guys want a free issue of the newsletter, go to our website, 77financialgroup.com, flip on the burger, and you'll see the trading desk, and then just select the free option and give it a read. And if you like it, then subscribe. You know, we're here to be a resource for you, educational. We love this stuff. So that's it for today, guys. As always, invest early, invest often. We will see you next week.